Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Monday morning, August 17, 2015, and the title of this week's audio blog is The Dire and Immediate Ramifications of Last Week's Historic Yuan Devaluation. As I tape this, it is indeed Monday morning, with roughly half the audio blog scripted yesterday and the remainder today. I have many important topics to discuss today of vital importance to your cumulative financial futures. However, the passing of one of the great people in my life, whom sadly I had no idea was sick, has compelled me to start with a brief eulogy. To wit, when growing up on Long Island, New York, my favorite sport was floor hockey. In fact, I loved it so much I was literally famous for how often I practiced. Every day I spent hours outside taking shots on my net with my Milex stick and orange hockey ball, to the point that my favorite net was eventually held up by a cone, several rolls of tape, and a stick. Actually, I became so good at floor hockey, I played center, that to this day I believe it was the single thing I ever excelled at most. And without a doubt, if you ask people I played with in the 1980s, they probably still remember how I played. Fortunately, Long Island was a hotbed for hockey at the time, given the incredible 4 straight Stanley Cups won by the New York Islanders. And wouldn't you know it, for some strange reason, despite growing up 10 miles from the Nassau Coliseum, which sadly the Islanders left after this past season, I was, and still am, a New York Rangers fan. That arbitrary, nonsensical turn of fate caused me more misery throughout my childhood than you can imagine. But heck, look at my choice of owning government-suppressed gold and silver today, as opposed to government-supported stocks and bonds. But that's another story for another day. Anyhow, living in Islanders country, there was a uniquely large amount of opportunity to play floor hockey. The game was so popular, there were even a handful of neighborhood teams that periodically played. I, of course, captained one myself, and have very fond memories of playing rival teams in a neighborhood schoolyard's parking lot, with my very best friends at my side in some of the most competitive games I've ever played. I've played. However, some of my best childhood memories, not just of hockey, but camaraderie, competition, and the kind of time so happy it's impossible to sleep afterwards, relate to playing floor hockey at the Mid-Island YMHA on Wednesday and Sunday evenings. The Y, essentially the Jewish version of the Village People's YMCA, was a local community center featuring everything from educational courses to social gatherings and athletics. And from the time I was 13 until I went off to college, it was my home away from home. As a member, I used its gym regularly, got a discount price for my SAT review course, and of course, played floor hockey for countless hundreds of hours. Wednesday nights were reserved for pickup games with people who, to this day, I am still in touch with, and Sunday nights for pickup games off-season, and league games when the YMHA's team, the Wylanders, were playing. As you can imagine, I played for the Wylanders as well, traveling around Long Island to play teams from other YMHAs. And we weren't just good, but really good. Anyhow, the man behind the Mid-Island Y's floor hockey program was named Steve Boshin. His day job was a high school math teacher, in fact at one of the worst school districts on Long Island, Roosevelt, best known for having produced both Eddie Murphy and Howard Stern. However, by night he organized many of the Y's youth athletic activities, none more so than the wildly popular floor hockey program, which he spent countless hours residing over. Yes, he theoretically coached the Wylanders and managed the pickup games. But in reality, he was simply the guy that made sure the doors remained open for local youth, like myself, 2 nights a week, and for the better players organized the schedules and travel for the Wylanders, including, I might add, driving the bus. In other words, he made it possible for young teenagers like myself, struggling with the most difficult hormonal years of our lives, to have a productive, accepting outlet for our angst. And not just in safe middle-class neighborhoods like mine, but difficult ones like Roosevelt as well. Anyhow, the last time I saw Steve was the handful of times I returned from college to join the younger guys for a routine pickup game, like clockwork on Wednesday and Sunday evenings. My guess, circa 1988 or so. As it turns out, unbeknownst to me until this weekend, that was the very time he became head boys counselor at Timber Lake Sleepaway Camp in upstate New York. And as someone who attended sleepaway camp myself for 4 years, as a camper, waiter, and CIT, I'm well aware of how special such situations are for children of all ages. Frankly, I'm not surprised he became the head boys counselor at one of the East Coast's largest sleepaway camps, a position I just learned he held for 29 years until dying of a long battle with leukemia last week. In fact, he had no intention of retiring when he died, and doing some simple math, I'd guess he was around 65 years old. Here at the Miles Franklin blog, I write of the increasingly turbulent state of the global economy and financial markets. That said, I have always maintained that the most valuable asset one can possess, particularly as one fights for their financial life, is the ability to identify and ally with the handful of good, smart people that not only know what they're doing, but have your best interests at heart. Steve Beauchamp, may he rest in peace, was one of the good, smart people in my life long before I had a vocation, a family to feed, or an understanding of economics or finance. Plain and simple, he was one of the best people I've known, having helped to shape the personalities and boost the esteem of countless thousands of boys of all ages. The world is a far lonelier place without him, and despite not having seen him in 25 years, I feel a deep sense of sadness at not having had the chance to say goodbye. Okay, back to the polar opposite of Steve Beauchamp's goodness, let's start today with Greece, which, despite the relentless rhetoric, propaganda, and general bad-mouthing, is on the verge of collapse not due to the failures of its hardworking people, but a handful of corrupt, ambitious, and naive politicians. Starting with being hoodwinked into joining the European Union at the turn of the century, made possible only by the assistance of Wall Street, most notably Goldman Sachs, and masking its debt with off-balance sheet vehicles, Enron style, Greece became the poster child of how an ill-conceived monetary union destroys its weakest financial links first, en route to all parties involved. According to Mark Grant of Southwest Securities, who has clearly become, to use Wall Street parlance, the axe on the Greek debt situation, said off-balance sheet vehicles amount to roughly 300 billion euros, atop the roughly 350 billion euros of on-balance sheet liabilities widely described as its true debt level. In other words, even before the laughable bailout number 3, which went forward despite most of Europe against it, Greece's dramatic landslide oxy vote by its own people, and one of the members of the Troika that oversaw the first two bailouts, the IMF, still not committed to participating. After it does occur, however, Greece's true debt to GDP ratio will be perhaps double the reported 170% or so. And thus, assuming Germany's Bundestag approves it on Wednesday, despite Angela Merkel just today, or I should say yesterday, claiming there is no certainty it will be successful, Greece's true debt to GDP ratio will rocket well above 300% and perhaps 400%, making it the single most indebted first world nation in history. And this, well, it's not essentially all, but all the 86 billion euros of new funding, fresh from the ECB's printing presses, being used not to help Greece, but pay back said Troika, including the IMF, which isn't even part of the bailout. Worse yet, according to Mark Grant, a $55 billion collateralized assets fund of state assets to be handed to the Troika if Greece defaults on a single interest payment will be created this fall. And oh yeah, the European Union now owns all assets of all Greek banks. So if you think Greece is not headed for a near-term Grexit, or for that matter, a hideously destabilizing political revolution, I've got a bridge to sell you in Brooklyn. And don't forget, Europe's economy is at its weakest level since the Union commenced in 1999, with last week's disappointing 2Q GDP report depicting an across-the-board flatline for the entire continent. And this with the horrific economic impact of the late stages of the current Greek crisis, not to mention the horrifying global currency, commodity, and high-yield bond collapses not yet incorporated. And thus, whatever economic ugliness transpired in 2Q, you know, when the Eurozone's fraudulently goosed GDP calculations only produced 0.3% growth, ironically purporting Greece to be its fastest growing nation, will be nothing compared to the near certain negative numbers to be reported in Q3, just in time for the aforementioned highly likely Greek political revolution, as well as Spain's presidential election in December, Portugal's in January, and likely the UK's vote as to whether to Brexit the European Trade Union entirely later in 2016. After Greece, Portugal, and Spain, After Greece, Portugal and Spain are the two weakest pigs, the latter of which already saw nearly 90% of the population of its wealthiest province, Catalonia, vote last year to secede from Spain. And don't forget Italy, where Beppe Grillo's five-star movement, i.e. the majority party in the Italian parliament, is actively circulating a petition regarding the secession of Italy too from both the European Union and Euro currency. So no, not only has nothing been resolved in Europe, but the political, economic, and financial hell on earth has barely begun. And oh yeah, said hell is occurring despite the ECB having launched one of the most ambitious NERP and QE programs ever 6 months ago, not to mention increasing it by more than 10% barely a month later. And thus, if anyone really believes central bankers know what they're doing, I've got not one, but two bridges in Brooklyn to sell them. Which I might add is yet another platform I have shouted of for years against not just Wall Street, Washington, and MSM propaganda, but the cluelessness of the masses, i.e. that central bankers not only utilize the most fundamentally flawed and historically proven failure of a thesis to guide all they do, i.e. Keynesianism, or the belief that government should interfere in all aspects of economic and monetary policy, but moreover, they have not a clue how to deploy it, particularly in today's world of historic debt, leverage, communications, and 24/7 trading. To that end, I've been particularly vehement in my view that the Chinese are amongst the worst economic managers on the planet, destroying all they touch, contrary to the common knowledge that China is deftly plotting and planning global domination. To the contrary, they have not only destroyed the upcoming decades, but put themselves on the front lines of political, economic, and financial disaster. Thankfully for them, their long-standing love of precious metals, learned from 1,000 years of history, given that China was the first nation to experience the hyperinflation inherent in all fiat Ponzi schemes, has put them in a position to rise from the upcoming economic ashes the world will shortly be enveloped in, when inevitably they are forced by a plummeting yuan to disclose their true gold holdings. Unfortunately for the current Chinese population, as well as its government, municipalities, and corporations, such a revival will not be possible until the end game of global currency collapse occurs, which, in the Miles Franklin blog's view, has already begun. And by the way, if you want a good third-party analysis of the idiocy of central bankers, not just in China but the world round, I urge you to read this weekend's article by Doug Noland titled Ruminations on China's Bursting Credit Bubble, which, I might add, featured one of the best analogies of all time, in calling upon Mike Tyson himself to describe how clueless central bankers are in claiming everybody's got a plan until they get punched in the mouth. As for said commodity crash, I have been warning of the political, economic, and financial horrors it would engender since last October's crashing oil prices portend unspeakable horrors, which I might add was published when WTI crude was still $81 a barrel, compared to Friday's 7-year low close of $42 per barrel, which is where we stand this morning. And if prices have fallen all the way back to levels now seen in 2004. Aside from December 2008 spike bottom low of roughly $31 a barrel, we have not seen oil prices this low in more than a decade. And the scariest part of all is that WTI prices are with WTI prices $11 per barrel higher than in December 2008, the CRB commodity index is now lower than that period, representing the height of global fear amidst the worst financial crisis of our, to that point, lifetimes. In other words, the collapsing CRB index is telling us that global economic activity is worse than that of the lowest point of the 2008 crisis. And sadly, the fundamentals for commodity prices have never been worse, let alone for the global economy as a whole, given that tens of trillions of unpayable debts have been added, interest rates taken to zero or lower, central bank balance sheets completely destroyed, and the average currency down between 50 and 90%, with the inflation hell just starting, following last week's cataclysmic but patently inevitable entrance of China into the final currency war. Perhaps that's why global consumer confidence collapsed last week to modern time levels seen only during 2008's Global Meltdown 1 and 2011's Global Meltdown 2, or why, 15-year high in the Nikkei notwithstanding, Shinzo Abe's approval rating is at an all-time low, with just last week tens of thousands of Japanese taking to the streets to demand his resignation. Quite prescient, I might add, considering this morning's 2Q Japanese GDP print of minus 1.6%. Or heck, why not tens but hundreds of thousands of Brazilians took to the streets this weekend to demand the resignation of President Dilma Rousseff, who currently sports a nationwide approval rating of, drumroll please, 8%. I'll get to the yuan devaluation in a second and try to avoid taking a victory lap, given I not only predicted it back in April, but in Monday morning's upcoming cataclysmic financial big bang to end all big bangs less than 12 hours before it occurred. However, I want to remain on the topic of the historic, horrific commodity crash a bit longer, to emphasize that, despite last week's comically blatant PPT efforts to revive plunging stock markets and, of course, cap surging gold and silver markets, they miserably failed to prevent the biggest one-week crash in high-yield, i.e. junk bonds, since the Lehman Brothers collapse in October 2008. And no, it wasn't the bonds of multinational companies most exposed to Chinese trade that led the collapse, but energy companies, particularly the high-cost shale companies financed with roughly $500 billion of junk bonds and leveraged loans. And this with the Iranian peace deal not even signed yet, as the above-market financial hedges that are the only reason many such shale companies are still around are expiring as we speak. Trust me, the historic disparity between collapsing energy bonds and government-supported energy stocks will resolve badly. And trust me, there's a reason why the Dow recovered its losses, and laughably the Nasdaq bubble was miraculously rescued, not once, but 3 times as it sought to plunge below 5,000. Because while this is happening, more than half of all S&P 500 companies are now in the death zone, in which their 50-day moving averages have fallen below their 200-day moving averages, showing just how weak the breadth of the government-supported stock market has become. I mean, geez, Tesla reports one of the largest, most horrifying cash burns in corporate history, announces yet another horribly dilutive equity offering, which likely will only buy them a few more months of operations, and the stock acts better than silver on Friday, following yet another cartel paper raid right after the 10 a.m. Eastern Standard Time close of global physical markets. Just Thursday, in my must-read supplemental article, Silver Supply a 1.5 or 2.0 out of 10, and one of the most potentially last great silver investment opportunities, I wrote of how demand is so strong, Miles Franklin's inventories are falling to levels last seen in 2008. And yet, will Tesla, an imploding, government-subsidized financial black hole whose raison d'etre is the provision of hybrid cars in a high-energy price environment, saw its stock rise after one of the most cataclysmic financial announcements of our lifetimes, i.e. Mondays, Tuesdays, and Wednesdays' historic yuan devaluations, which I assure you are just jacks for starters. Will history's best safe haven asset, amidst record physical demand, was hit for an incredible 2.5% in a matter of minutes. And thus, to end this section, I'll simply give you one more trust me, which is trust me, the forces of physical demand for silver will overcome the cartel. And trust me, the non-existent demand for Tesla stocks, bonds, and cars will be overcome by market reality, no matter how hard the PPT fights it. As for China, I'm not going to rehash what I said in last Monday's Audioblog, the endgame starts as China devalues the yuan, or Tuesday's article, PBOC doubles down on devaluation, a day after claiming, in LOL, one-time adjustment, Wednesday's 3 devaluations a charm, if charm is defined as collapsing commodities and exploding currency wars, or last week's podcast with Greg Hunter, Kerry Lutz, and the Homestead Nation. That said, it is indeed the aforementioned cataclysmic financial big bang to end all big bangs, and thus there will be no shortage of incremental information to bring your way, such as this weekend's news that the IMF, notorious for miserably overstating growth, understating financial duress, and heavily vested in the fabrication of favorable economic propaganda, expects China's comprehensive debt load to balloon by an additional 20 percentage points relative to GDP in just the next 4 years. Or Ambrose Pritchard Evans' article about the hideous, unprecedented oversupply of steel, rebar, and other industrial commodities China is on the verge of unleashing upon the world, yielding an utter explosion of deflationary pressures that will only heighten the urgency of competing nations to devalue their currencies, which, in looking at this morning's emerging market currency movements, let alone since last week's yuan devaluations, is already being discounted by the market in spades. And for those that still live in the fantasy land where it's reasonable to assume markets are freely traded, China's Security Finance Corp, i.e. its version of the U.S. Working Group on Financial Markets, or PPT, put out a public statement Friday that, quote, for a number of years to come, the China Securities Finance Corp will not exit the market. Its function to stabilize the market will not change. When the market drastically fluctuates and may trigger systemic risk, it will continue to play a role to stabilize the market in many ways. In other words, we plan to continue printing money and supporting stocks overtly for the foreseeable future, which is exactly what other major central banks are increasingly saying, from the Bank of Japan to the Bank of Switzerland and several others. Essentially, they are so desperate to prevent the big one from washing over their collapsing economies like the virtually unlimited amounts of crude washing over global oil markets, they feel compelled to overtly state what we have known all along. And trust me, when the inevitable Yellen reversal results in whirlybird Janet joining the party, or admitting the Fed not only manipulates, i.e. suppresses, interest rates by buying bonds, but manipulates stocks as well via management of the aforementioned PPT. As for the painstakingly pathetic topic of whether or not the Fed will raise or lower interest rates, which I might add we'll get a better idea of Wednesday afternoon when the FOMC releases the doctored minutes of its uber-dovish July 29th meeting, there too I am not going to rehash the countless reams of paper and decibels of airwaves I've devoted to the topic, such as December 2013's Proof of the Tapering Mirage, and last October's End of QE LOL and Countdown to the Yellen Reversal. However, yet again, how many more points can we supply as to how patently ridiculous the concept of raising rates into a collapsing global economy is, such as, egads, the Empire State Manufacturing Report, which as I write was just published, coming in at, drumroll please, negative 14.9 versus positive 3.9 last month, and the expectation of a slight rise to positive 4.8. In other words, a fresh 6-year low to a level last seen at the heart of the 2008-2009 crisis. As noted above, commodity prices are collapsing, and by the way, as I write Monday morning, said collapse is going into hyperdrive, with what do you know, only gold and silver moving higher. Not to mention, economic data the world round, including industrial production, government and corporate revenues, retail sales, and most ominously, sentiment. Meanwhile, the U.S. government's tax revenues are plunging, and once it runs out of extraordinary measures this fall, like stealing from public pension funds, its unprecedented debt levels will explode further, requiring still lower interest rates to fund it. Not to mention, the Fed is the world's largest, most highly leveraged fixed income hedge fund, and thus raising rates even a minuscule amount will cause catastrophic losses to U.S. taxpayers, which can only be covered via further money printing. Throw in the historic catastrophic yuan devaluation last week, which again is just jacks for starters, and it becomes patently obvious that even the slightest interest rate hike will cause the dollar, already in the stratosphere due to the global liquidity vacuum I predicted nearly 2 years ago, to go utterly parabolic, to the chagrin of the most overvalued equity market in U.S. history, multinational corporations whose earnings per share, historic stock repurchases and all, are already in decline, and the White House, which has loudly, overtly warned of the economic headwinds the strong dollar is causing. Not to mention, next year is an election year, and if Hillary Clinton doesn't win, there's not a chance in hell Janet Yellen is reappointed as Fed chairman. So, to the question of whether or not the Fed will ever again raise rates, let alone LOL next month, I can only answer as such. If they were crazy enough to do so, even by a measly, immaterial 1/8 of a percentage point, even I might be forced to believe conspiracy theories claiming there is a plan to take that system down from within. I say this facetiously, of course, but the reality is no different. In other words, we are in the final terminal phase of history's largest, broadest fiat currency scheme, and thus the only way the proverbial can be kicked even a few more feet is by exponentially expanding QE, ZERP, and even NERP, or negative interest rate campaigns. By hook or crook, by force or manipulation, or economic Mother Nature, this is what is coming, and far sooner than most can imagine. Which is probably why global physical precious metals demand is at record levels, soaring higher with each passing month, particularly in the Achilles heel silver market, which per last week's must-read article, silver supply is at a 1.5 or 2.0 out of 10, is as close to a 2008 style shortage as at any time since, well, 2008. As evidenced by last month's record July U.S. Mint Silver Eagle sales, despite the suspension of said sales for half the month. To that end, we can only reiterate, as vehemently as possible, that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. In fact, not only did I tape the aforementioned podcast with Miles Franklin's president and co-founder Andy Scheckman earlier this year regarding swaps, trades, and repatriations, but last month, State of the Bullion Industry, in which Andy spoke of matters investors must be aware of in the current environment of product shortages, bankrupt competitors, and the prospect for further market tightness. As for Miles Franklin, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals, on average sporting 22 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.